Stock prices represent ownership shares of companies. Imagine, if you will, a giant pie cut into millions of slices. Each slice is a share of stock. The price of a slice or share fluctuates based on various factors. It's like a constant auction where buyers and sellers determine the price. Prices go up when demand exceeds supply. Conversely, prices drop when supply outweighs demand. This dynamic interplay determines the value of your investment. Understanding these fluctuations is crucial for investors. The stock market is like a giant flea market. Imagine walking through rows of stalls, each one offering something different. Instead of used furniture or vintage clothing, though, we're trading pieces of companies. These pieces, known as stocks, represent ownership in a business. Just like at a flea market, the value of these items can fluctuate based on demand and supply. Instead of used furniture, though, we're trading pieces of companies. Each stock represents a small slice of a company, and owning a stock means you own a part of that company. Investors analyze financial reports, study market trends, and make decisions based on a variety of factors. They look at charts, graphs, and data to predict how a stock will perform. These pieces, called stocks, are bought and sold every second of every trading day. The trading floor is a hive of activity, with traders shouting bids and offers, making rapid decisions. Electronic ticker boards flash constantly, displaying the latest prices and trades. It's a fast-paced environment where every second counts. Think of the New York Stock Exchange as the biggest, busiest flea market on the planet. Located on Wall Street in New York City, it's a symbol of global finance. Inside, traders work tirelessly, buying and selling stocks to meet the demands of their clients. The building itself is an iconic landmark, representing the heart of the financial world. Buyers and sellers from around the world converge here. The stock market is a global marketplace with participants from every corner of the globe. Different time zones mean that trading never really stops. International traders bring diverse perspectives and strategies, contributing to the dynamic nature of the market. They place bids and offers, creating a constant dance of price discovery. This process determines the value of stocks at any given moment. Traders use sophisticated technology to place their bids and offers, ensuring they get the best possible price. It's a complex system that relies on both human intuition and advanced algorithms. It's a fascinating spectacle of capitalism in action. The trading floor is a microcosm of the broader economy, reflecting the hopes, fears, and ambitions of investors. Every gesture, every shout, every trade is part of a larger narrative. It's a place where fortunes can be made or lost in an instant. Fortunes are made and lost in the blink of an eye. Market fluctuations can lead to dramatic changes in stock prices, affecting the wealth of investors. Emotions run high as traders react to news, earnings reports, and economic indicators. It's a high-stakes game where the rewards can be immense, but the risks are equally significant. Supply and demand are the cornerstones of stock prices. When more people want to buy a stock than sell it, the price goes up. It's like a bidding war for a rare collectible. Conversely, if more people want to sell than buy, the price drops. Think of it like this: high demand equals higher prices. Low demand equals lower prices. It's a simple concept, but understanding it is crucial for navigating the stock market. A company's performance plays a huge role in its stock price and overall market perception. If a company is doing well, growing its profits, and innovating, investors get excited and optimistic. They want a piece of the action, driving up demand and therefore the stock price. Conversely, if a company is struggling, losing money, or facing challenges, investors get nervous and anxious. They may sell their shares, increasing supply and pushing the price down. It's all about perception and future prospects in the market. Section 5. Earnings fueling the engine. Earnings are a company's profits. They're the lifeblood of a business, and investors watch them closely. Strong earnings usually lead to higher stock prices. Investors love to see companies making money and growing their bottom line. Weak earnings, on the other hand, can spell trouble. Investors may lose confidence, leading to selling pressure and lower stock prices. Earnings reports are key events for publicly traded companies. They can make or break a stock. Section 6. Market sentiment, the X factor. Market sentiment is the overall mood and attitude of investors. It's the emotional temperature and pulse of the market. When sentiment is bullish, investors are optimistic and confident. They're more likely to buy stocks, driving prices higher and higher. Conversely, when sentiment is bearish, investors are fearful and cautious. They're more likely to sell, pushing prices down significantly. Market sentiment can be influenced by a wide range of factors, from economic news to major geopolitical events. Section 7. Real-world examples. Apple and Tesla. Let's look at some real-world examples. Apple, known for its innovative products, has consistently delivered strong earnings. This has resulted in a steadily rising stock price over the years. Investors love Apple's products and its ability to generate profits. Tesla, the electric car manufacturer, is another interesting example. Tesla's stock price has been on a roller coaster ride, driven by both its innovative technology and CEO Elon Musk's often unpredictable behavior. Section 8. The news cycle. Information overload. The news cycle constantly bombards us with information, some relevant to stock prices, some not. Every day, we are inundated with a flood of data, from breaking news alerts to in-depth analysis. It's important to filter this information and focus on the factors that truly matter. Don't get caught up in the hype or panic created by every news headline. The sensationalism of the media can often lead to emotional reactions, which are not always in your best interest. Remember, not all news is created equal. Some news is noise, while other news is important. The key is to develop a discerning eye and learn to distinguish between the two. This means understanding the source of the information, the context in which it is presented, and its potential impact on your investments. Don't let the news cycle dictate your investment decisions. Instead, take a step back, analyze the information critically, and make informed choices based on solid research and analysis. By doing so, you can avoid the pitfalls of reactionary decision-making and stay focused on your long-term investment goals. Remember, in the world of investing, knowledge is power, but only if it is the right knowledge. Stay informed, stay focused, and don't let the noise of the news cycle overwhelm you. Your financial future depends on it. Section 9. Long-term versus short-term, a balancing act. Investing is a marathon, not a sprint. While it's tempting to chase quick profits, it's crucial to have a long-term perspective. Short-term fluctuations in stock prices are inevitable. Don't panic and make rash decisions based on short-term movements. Remember, time is your friend in the market. Over the long term, the stock market tends to go up. Stay focused on your goals, ride out the volatility, and you'll be rewarded. Section 10. Understanding risk riding the waves. Investing in the stock market involves risk. Prices can go down as well as up. It's important to understand and accept this risk before investing your hard-earned money. Don't invest more than you can afford to lose. Diversification is key to managing risk. Don't put all your eggs in one basket. Spread your investments across different companies, industries, and asset classes. This will help cushion the blow if one investment doesn't pan out. Section 11. Key takeaways, your investment journey. In this chapter, we will delve into the essential aspects of investing that every investor should be aware of. Whether you're a novice or an experienced trader, understanding the fundamentals is key to navigating the complex world of investments. Understanding how stock prices are determined is crucial for any investor. Remember, supply and demand, company performance, and market sentiment all play a role. These factors can fluctuate based on a variety of influences, including economic indicators, geopolitical events, and even market speculation. By keeping an eye on these elements, you can better predict market movements and make more strategic decisions. It's also important to diversify your portfolio to mitigate risks. Diversification means spreading your investments across different asset classes, industries, and geographies to reduce the impact of any single investment's poor performance. By grasping these concepts and staying informed, you can make more informed investment decisions. Regularly reviewing your portfolio and staying updated with the latest financial news can help you stay ahead of the curve. Additionally, consider consulting with financial advisors who can provide personalized advice based on your financial goals and risk tolerance. Investing in the stock market can be a rewarding way to grow your wealth over time. Remember to start small, do your research, and most importantly, stay patient. Patience is a virtue in the world of investing. Market fluctuations are normal, and it's essential to stay calm and avoid making impulsive decisions based on short-term market movements. The journey to financial freedom is a marathon, not a sprint. It requires discipline, continuous learning, and a long-term perspective. By setting realistic goals, creating a solid investment plan, and sticking to it, you can achieve financial success. Remember, every small step you take today brings you closer to your financial dreams. Stay committed, stay informed, and enjoy the journey.